for the next 4 years, guaranteed. That's the demand impact, right? $8.5 billion, $23 million a day at the current price. Now, that's a huge amount, but more importantly, that's a huge demand-supply shift in the year when the demand via the ETFs has jumped by a factor of 4 to 10 times the daily supply. So what you have is institutional capital entering, and then you have the supply getting cut in half. And, what happened with these ETFs? Well, here's what happened. The approval of the ETFs was a pretty concrete endorsement of Bitcoin as an asset class by the regulators. And anybody who's thinking about banning Bitcoin or not approving Bitcoin ETFs, they're now out of consensus. So it really flipped the global consensus from, well, maybe it's too good to be true, maybe it'll be banned, maybe it won't be banned. The approval of those ETFs meant that it doesn't matter who wins the 24 elections. It's taken the future of Bitcoin out of the hands of the president. It's taken it out of the hands of the next head of the SEC. It's taken it out of the hands of most regulators in the world. We pretty much opened Pandora's box or crossed the Rubicon. It's very concrete at this point. And it was uncertain, right, before. And so that's a very big piece of regulatory clarity. What happened next is it's created a positive dynamic where now I think you're seeing pressure to approve ETFs in other places in Asia. You'll probably see Hong Kong spot ETFs. You'll probably see them get approved in any country where people are on the fence. It also created a fee war. It used to be that you paid 2.5%, to hold your money in grayscale. And all of a sudden now you're paying 1.5% at grayscale, but you're paying 25 basis points at BlackRock, or you're paying 20 basis points and even 19 basis points. Not only did that bring down fees for institutional holders of Bitcoin in the US, it also put pressure on international fees. Let me convert the math here. If you have an infinite duration asset and you're going to put, if you're going to put money in it, then the difference between 2% fees and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor, having low fees means you invest $1 million and you get to keep the $1 million. Having high fees mean you invest $1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up. Right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest $1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from real estate into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment. It's got the best historic performance. And of course, it doesn't have the entire array of risk factors that a company has or that a bond has. It doesn't have credit risk. It doesn't have corporate execution risk. And it doesn't have currency devaluation risk. And it doesn't have the physical risks of real estate. It's not going to get hit by a bolt of lightning. There's not going to be a tornado. It doesn't have maintenance decay. It doesn't have property tax risk. It doesn't have the political risk. Right? Ask yourself the question, you got $1 billion and you got to buy some real estate in Africa? Where? Where do you want to invest $1 billion in a building? What country? What city? Where? Or you can buy Bitcoin. And of course, so you can see this is a higher quality thing. What was Bitcoin's #1 liability coming into 2024? It wasn't the risk. It wasn't the thermodynamic risk factors. It wasn't the technical capabilities. The #1 risk factor of Bitcoin coming into 2024 was a government would ban it. But see what just happened in January? The opposite, right? So most of the FUD around Bitcoin is, oh yeah, it's too good to be true, and because it's too good to be true, the government's going to hate that you bought it, and they're going to take it away from you. And with the approval of these ETFs, it was the government of the most powerful country in the world, the United States, which is actually the leader of financial regulation. I mean, whatever the US does will influence Singapore, Australia, New Zealand, all of the EU, even Hong Kong, even China for that matter, and all of South America, and all the African regulators. So everyone's looking to what happens in the United States. This was a very powerful signal. So that was a bullish development. There was a little bit of weakness following, and I think that's fairly well understood as a couple of factors. First of all, a lot of capital rebalancing. There was capital sitting in the futures, BITO and other Bitcoin futures, because institutional investors don't have crypto accounts. They can't trade with most of the crypto exchanges, so they had to buy the futures. And the cost of rolling a Bitcoin position in the futures is like 10%. Imagine you have $1 million and someone charges you $100,000 a year just to have the trade on, right? I mean, so you could see anybody with that position, they roll out of the futures and they're rolling into the spot. So there's a lot of that. There were some people rebalancing. They had positions in Bitcoin companies and the miners and MicroStrategy, et cetera. And they're rolling out of those trades or rebalancing or arbitraging. There was a lot of people trapped in Grayscale and they couldn't get out, and then this unlock allowed some of them to redeem at par. And so there are some people that had 5 years of pent-up demand to redeem, and so we worked through that. And then you have the arbitraging between the high fee Grayscale and the lower fee other ETFs, and then finally